For just about every investor out there, there's this legendary prize they're all searching for. It's this single, perfect strategy that guarantees a win no matter what the market is doing. People call it the Holy Grail of investing. So let's dive into what that is, because one of the most successful investors on the planet claims he's actually found it. So here's the big question, right? It seems so simple, but the answer has stumped the greatest financial minds for, well, centuries. How do you build a portfolio that actually thrives when times are good, survives when things get ugly, and consistently comes out ahead? Most of us think the answer must be some kind of cheat code, a secret formula that just prints money with 100% returns. But here's the reality. Even the most brilliant professional investors, the ones paid millions, are considered rock stars if they can just beat the market half the time. A 100% win rate? Yeah, that's pretty much seen as impossible. Impossible, that is, for almost everyone. Except, well, for this guy. This is Ray Dalio. He's the founder of Bridgewater Associates, which is the largest hedge fund in the entire world. He spent his whole career obsessed with this one problem, and eventually, he cracked the code. So, what is this revolutionary secret? Well, it all starts with a rule that goes against pretty much everything most of us have ever been taught about making money. If I asked you this question, what's the first thing that pops into your head? You're probably thinking about finding the next big stock, right? The next Amazon, the hottest new trend. We're all wired to chase those huge returns. But Dalio's answer is the complete opposite. He says if you really want the highest possible profit, you have to start by focusing on lowering your risk to its absolute minimum. I mean, this just flips that old high-risk, high-return idea completely on its head. It goes against our gut instinct to chase the exciting, flashy stuff. Okay, so how on earth do you lower risk and still boost your returns? It really boils down to two key concepts. You've probably heard of the first one, but trust me, the second one, that's the real secret sauce. So everyone knows about diversification. Don't put all your eggs in one basket. But Dalio argues that's just not enough. The crucial part, the real game changer, is owning assets that are uncorrelated. And that just means they don't all react to market news in the exact same way. So what exactly is correlation? It's really just a simple way to measure if two different investments tend to go up or down at the same time. That's it. And this illustrates the idea perfectly. Think about Coke and Pepsi. They're in the same business, right? So if some news comes out about a sugar tax or whatever, both of their stocks are probably going to react in a similar way. That's high correlation. Now, compare that to real estate in Thailand and an oil company in Saudi Arabia. I mean, they're in totally different industries on opposite sides of the world, driven by completely different forces. That's what we call low correlation. All right, let's actually visualize this, because when you see how this one simple idea, focusing on low correlation, actually works, it is incredibly powerful. So just picture a simple graph. The up and down axis, the vertical one, that's risk. Think of it as your chance of losing money. Higher up means more risk. And the side-to-side axis, the horizontal one, that's just the number of different things you own in your portfolio. Now let's say you diversify by buying 15 or 20 assets that are highly correlated, like say 20 different tech stocks. You can see your risk goes down a little bit as you add more, but then it just hits a wall. It flatlines. Why? Because they all tend to move together. If the whole tech sector has a bad day, your whole portfolio takes a hit. You've spread your money out, but you haven't actually spread your risk. But look what happens when you add 15 to 20 uncorrelated assets. The effect is completely different. As you can see, the risk doesn't just dip a little, it absolutely plummets. When your assets don't move in sync, a loss over here can be canceled out by a gain over there. This is the real secret to the Holy Grail strategy. And the numbers on this slide really tell the whole story. Just look at the risk of loss column. With typical diversification, where everything is highly correlated, you're still facing a nearly 40% risk. But by focusing on low correlation, you slash that risk all the way down to just 12%. And here's the magic part. By cutting your risk so dramatically, you create a much more stable portfolio that can grow more reliably. The result? A profit potential that's 4 times higher. It's the ultimate win-win. And hey, don't just take my word for it. Dalio himself puts it very plainly. He says the magic is to find 15 to 20 good uncorrelated return streams. It really is that simple and that profound. Let's make this super real for a second. Think back to early 2020. If your portfolio was packed with highly correlated travel stocks, airlines, cruise lines, hotels. You were absolutely decimated. When one went down, they all went down together in a heap. But if you had a properly built, low correlation portfolio that also included things like e-commerce, streaming services, and other tech stocks, the story was completely different, right? While the travel industry was collapsing, the stay-at-home economy was absolutely booming. The gains in one area helped cancel out the losses in the other, protecting your entire portfolio. So the crucial point here is that you don't have to be some kind of genius who can predict the future. You just need a better system. So let's boil this whole strategy down into 4 simple rules you can actually use. So here it is, the whole strategy in 4 steps. Rule 1 is all about humility. Just accept that you can't predict the future. No one can. Rule 2 is that huge mindset shift. Stop chasing profits and start by obsessing over minimizing your risk. Rule 3 is your main mission. Make it your goal to find those 15 to 20 good, uncorrelated assets. And Rule 4 is about what that really means. Diversify intelligently. Don't just buy different tech stocks. Buy different industries, different asset classes like gold or real estate, and even assets in totally different countries. That is how you build a truly bulletproof portfolio. Ultimately, what Dalio found, this Holy Grail, isn't about being a market psychic or having a crystal ball. It's about building a robust machine that can handle anything and everything the world throws at it. So the final question is this. If you don't need to predict the future to win, what's really holding you back?